So I'm just going to allow a little bit of time for people to filter in. But as we're starting, I'll say good morning and thank you to those who are in and those who are coming in for attending our first Simon Talk of 2023. As you know, or those who've been to these before or zoomed into these before, really what we're about, or what the Simon Talks are about, is sort of gathering up those people that we work with regularly and that we borrow from liberally, as we think about how we address from a policy perspective the ongoing housing and homelessness crisis. And obviously over the last 10 years, the amount of time that we start talking about the housing system has, probably 15 years ago, we would have talked a little bit less. Certainly 20 years ago, we would have talked about emergency provision, about care, about support and getting people through the trauma of homelessness. That still happens. We still need to talk about that a lot. But we also need to understand what's happening in the social and economic that is driving the structural inequality in our housing system. And that's obviously very much the words I'm putting to it there are very much the Simon perspective. I think where the Simon Talks come in for us is that we feel there's a real value in bringing in those people from who we do borrow liberally and who are doing quality work in the different facets, and that we borrow from to allow them to present to the supporters and colleagues who work with the Simon communities. So it's coming first and people see how we get to where we get, but also that we're making that, or providing opportunities to platform that work some more. That said, when you're talking about the ESRI and Professor Conor O'Toole, who's speaking to us today, it's really slightly disingenuous, because obviously anyone who's interested in housing and in economic and social policy will be aware of Conor's work and the work of the ESRI. But to introduce him, Conor is an associate research professor at the ESRI and an adjunct professor at Trinity College, an associate professor at Trinity College Dublin. His research covers the areas of macroeconomics, banking and the housing market. He's co-editor of the ESRI's quarterly economic commentary and is published in a number of leading academic journals, such as the Journal of Money, Credit and Banking, Review of Finance and the Journal of Housing Economics. Prior to joining the ESRI, Conor worked as manager of the macro financial linkages team in the Central Bank of Ireland. And I'm exhausted just reading his bio, so I can't imagine how he got through all that. But so I'm going to hand over to Conor now, and then we'll do a Q&A afterwards. I think Conor's going to speak for about 30 minutes, 20, 30 minutes.
Yeah, about 20, 30 minutes, exactly, yeah.
Yeah. And then we'll go to Q&A. In the interim, if you are, and please do tweet and whatever other social media you do, and if you can use the hashtag Simon Talks so we can continue the conversation. This video will also be recorded and uploaded to YouTube, so if you want to revisit anything or share it more widely in your organizations, please do, and it'll be up probably within the hour of us finishing. So with that, I'm going to hand over to Conor, and with our thanks for being here today.
Thanks very much, Wayne, and thanks everybody for joining us this morning. Just bear with me 1 second while I share my screen here. Okay, great. Thanks very much. So I guess first, before I start, I just want to say thanks to the Simon team for their invite to talk at this particular event. We did it last year, and as part of the Simon Talks suite of seminars that are organised, which are a great idea, and very glad to be able to come back and contextualize where we are at this point early in the year, and what lies ahead for both the Irish economy in general, and in particular for the housing market. And I'm going to talk, in the early part of the discussion, I'm going to go very high level. I'm going to talk about our kind of broad economic forecasts and our thinking about what are the key themes that are affecting the Irish economy quite in a general context. And then I'll hopefully, towards the end of the discussion, narrow in a little bit on the housing market, and we can draw out some of the issues around the housing market. Some of the challenges that we see out there and going to be the most problematic in terms of particular in terms of delivering housing supply, being the big one that we always keep coming back to in the present. How can we keep supply going, and how can we get affordable supply into the market? So that's what I'm hoping to do over the coming period. Okay, so where are we now with the Irish economy? Obviously, we came through the pandemic in reasonably good shape. I think the best way to explain or to reflect on what happened over the period of the public health period of the pandemic was that there was huge disruption to the Irish economy, but that the government stepped in where it was needed to, and really underpinned many of the economic systems that needed to, with the supports for businesses and households, when those lockdown periods were occurring. And with that, actually the Irish economy has actually weathered the storm reasonably well. There were some structural factors that allowed the economy to be able to deal with that. For example, we've quite a high share of industry or in the services sector, which allowed people to be able to work from home and make those kind of transitions reasonably smoothly. And we had a big multinational sector, which I'll talk about in some detail, but that really helped us pull through in terms of the broader economic structure. So certainly, we exited the pandemic period in as good a shape, I think, as we could have, given the size of that particular shock. What happened then was, just as we were about to see a renormalization of the economic conditions and economic life and social life, the war in Ukraine occurred, and that just sent shockwaves through, in particular through the energy markets, and led to a unraveling of business relationships where Russia was involved and changed political landscapes, and the most important of all, the huge humanitarian crisis which has occurred, and which is a responsibility on every single European country to try and do their bit. And that adds pressure as in the Irish system, in particular in the housing market context, as the refugees require that housing, and we must be able to find a mechanism to provide that. So in a sense, if you look at the little table I have there, this provides the economic forecasts for next year, but also looks back to 2021. And you can see the GDP there, that's the value of all goods and services produced in the Irish economy. And the number there, the growth rate. So you can see extremely rapid growth in 2021 and 2022 in Ireland. That's mainly driven by the multinational sector, huge export growth, which powered forward our economy. And that's a huge source of strength for the Irish economy, but also can lead to some risks with an over concentration of activity in the sector. But I'll talk a little bit about that going forward. And then you can see a notable slowdown expected into this year. The column on the very right hand side, which has the letters MDD, that's modified domestic demand. That's our measure, which tries to focus in more on a domestic economy. It includes household spending, business spending on stuff in Ireland, and government spending. And you can see still strong growth in 21 and 22, but then you can see the slowdown into this year. And when we think about that outlook and the broad context, it matters for the housing market for a number of different reasons. The ability of the economy to grow dictates the amount of resources that are available to the state to be able to address deficiencies and deficits, for example, in housing infrastructure. But it also, the degree to which the economy is growing, the temperature of the economy, which is one way to put it, also affects how much the state can do at what periodicity, because too much too soon can have adverse effects, especially as we are currently in one of the most high inflationary environments that we've seen in many years. Let me just kind of give a couple of broad factors which are important at present. We've seen towards the end of this year quite a notable slowdown in household spending. That's on the back of very rapid household spending earlier in the period as we exited the pandemic. So in early 2022, we saw a degree of catch up in that spending, where people were able to re-engage with normal economic activity, and that has slowed as the cost of living crisis really has kicked in, and many households are feeling the pinch in terms of their disposable income. That said, the labour market at present is still performing extremely well. We're near historical lows in unemployment, and that's a very good position to be in, entering into a period where we're looking at a lower growth outlook in the coming years. As I said, in 2022, our export growth was very rapid, and we do expect that to moderate this year as the global economy slows. You can see many of our big trading partners are facing slower economic growth, higher inflationary pressures, and with rising interest rates, all of this is kind of subduing global demand, and that will affect Ireland's a small economy. It relies on trade, and trade from multinationals in particular, and that will that we expect that to slow somewhat this year. One of the really strong elements of our current economic situation is that the public finances are in really good shape at present. Now, they're in really good shape for some specific reasons, which I'll talk about, but we do have a strong exchequer at present to be able to deal with current cost of living challenges or any other shocks that we experience at present. So just to kind of think a little bit more thematically about the risks to growth. So we are expecting the economy to grow, 2.2% modified domestic demand growth for next year, and that's reasonably strong relative to our peers. Many economies would be delighted to be able to post growth levels at those particular measures, but that is that is the enviable position we're in. But there are some considerable risks to that. We have, obviously the inflationary pressures are well known. Some of these are still due to the supply chain bottlenecks that we're facing, but mainly due to the very severely strained energy markets. As I've mentioned, our many of our global trading partners are experiencing slower growth. The UK economy is particularly the issues around Brexit, the trade disruption that comes from Brexit are starting to kick in. Inflation is higher there than in the other major economies, and really that's quite a negative outlook for the UK, and that because of our proximity and our historical linkages, that matters for Ireland. But more broadly, the international economy is slowing. Obviously, the very high inflation has elicited a reaction from policymakers in the form of higher interest rates, and I think we're going to be seeing over the period ahead higher interest rates for a longer period, and this has a number of implications for the housing market, both on the demand and the supply side. From a demand side, it's going to make it more expensive for borrowers to be able to draw down leverage, because each euro of credit will be more expensive to service. But on the supply side, it's going to be more difficult and more expensive for companies to borrow to invest in the housing, and also it'll increase interest rates on sovereign debt. So it does have consequences. I've mentioned earlier the humanitarian cost of the terrible war in Ukraine. this is an obligation, something we need to do, but we need to be able to manage that, and it is something we need to include in our considerations around managing the public finances and the provision of, particularly around the provision of housing. This particular chart comes from a new exercise that we've been undertaking over the last couple of months, which is what we've called a nowcast. It takes all the information we have available and tries to give us an in-time current assessment of where the economy is going. And we do it on the modified domestic demand indicator, because that's the best lens into what's happening in the Irish economy specifically. And you can see very clearly, since the start of 2022, when we had really strong growth, really strong rebound from the pandemic, there's a very clear downward trend in the growth rate of modified domestic demand as the cost of living pressures have kicked in, as the broader economy, the international economy has slowed, interest rates have started to rise. You can very clearly see a downward trend. Still growing, not talking about recessionary territory, but quite a marked slowdown in economic activity. We can see that downward trend very clearly. I think I don't want to talk about them in too much detail, is in particular is the contribution of the ICT sector to the Irish economy. Now, you may ask, that this is a little bit abstract maybe for discussions around the housing sector, but it matters for a number of reasons. It matters in particular because a huge amount of our corporation tax receipts are coming from ICT multinationals, and that is hugely helpful for the Exchequer to be able to have the resources to invest in infrastructure around housing supply in particular. But it does create vulnerabilities. And as we've seen, the international mood music around the ICT sector is quite negative. And as you can see with the chart here, the output per worker in Ireland, the ICT sector has been very different from the international picture. So this chart here shows how much output a worker makes for other countries, the EU 27, Belgium and France, and Ireland from the ICT sector. And it's way out of line, and that really is to do with the huge amounts of intangible capital that they brought in here. Why does this matter? Well, what we tried to do was say, well, what would happen if Ireland looked more like these other countries? If there's a renormalization of that sector? Well, what it suggests is that there could be quite a notable decline in output from that sector, and that would likely have knock-on effects for economic growth, and in particular for the public finances. So these are all risks that seem high level, but they really do matter when we think about them on the ground, because some of these risks materializing could have negative feedback loops down through the chain. Okay, so let me just talk about household spending a little bit. This is one of the normally the most stable items of the Irish economy, and it's one that gives us the best lens as to what's actually happening on the ground. And we can very clearly see over the past number of months that household spending has been coming down. Now, during the pandemic, it was forced to be restrained because the public health measures were in place, the lockdowns. So it kind of released and increased during the periods of the easing restrictions, then it restricted again. And then towards the early part of last year, when the measures were more permanently relaxed, it kicked in again. People went on kind of a bit of a spending spree. But then as the inflationary dynamics started to pick up, as some of the cost increases became more embedded in the Irish economy, then households began to feel the pressures from those higher prices. We have seen consumption drop quite markedly. Now, one of the interesting things about the or features of the Irish economy was a big increase in the savings ratio. So over the period of the pandemic, many Irish households were able to save quite a bit more, and that has stayed high in the period since the pandemic. Has dropped down a little bit. So it does, one of the reasons why we would say we'll still expect some growth in consumption this year is that there are resources in the economy to be able to consume. But our view is that the extent to which the prices have risen is likely to take some of that, the steam out of that particular channel through which growth is caused. One of the best lenses that we have into what's actually happening on the ground for households is how we measure uncertainty in particular. And this chart here, which goes to the end of the summer, but when you run it out, it's a similar picture, looks at consumer confidence in Ireland and for our other European countries. You can very clearly see since the onset of the war in Ukraine, there was a drop off in consumer confidence. Uncertainty rising, inflationary pressures rising, and households have begun to feel the pinch and to pull back. So this is really important context, because if Irish households really pull back, then that will have negative change in terms of employment, in terms of spending, in terms of how businesses are faring. So all of these elements are circular and linked, and are really important for the growth outlook. In terms of investment expenditure, this includes investment in housing, this includes investment in infrastructure, and also investment by businesses. And it was particularly due to the multinationals that was really strong in 2022. There was some big FDI investments which were driving the overall level of investment up. And we do expect, given the general broad international downturn, that some of that will moderate this year, but we do still expect investment to grow quite strongly. In terms of housing completions, I'll talk a little bit more detail about that when I talk about the challenges in the housing market. But our expectation was for about 28,000 units last year, so in 2022. So quite a notable increase in completions, though some of the factors we see, cost pressures in the construction sector, and some of the uncertainties, all leading to slightly lower level coming through in this year. So I think certainly some clouds in terms of the broader outlook. Yeah, I think that the construction sector, we've looked at consumer confidence, but if you think about business confidence, it's one of the best determinants of how much investment happens in the economy. And that's really important, because committing capital ensures people will are likely to keep employment levels high, then therefore they're likely to keep paying wages, they're likely to therefore have all those knock-on effects that are beneficial. And you can see nearly across all these sectors, there's industry, services, retail, particularly construction. The Irish chart has quite a notable decline over the middle of last year in the sentiment, which is broadly consistent with the international outlook deteriorating, but also the domestic economy deteriorating. So not to paint too negative a picture, because we are still expecting growth this year. There are many risks on the horizon, and much of the outlook is clouded by rising uncertainty, and in particular rising interest rates, and the global cost pressures. Obviously, exports, I'm not going to dwell too much on this, but exports have really been one of the channels through which the Irish economy has performed extremely well over the past number of years throughout the pandemic. We were really lucky in the pandemic period that the export structure that we had, the two sectors that were really strong in terms of our exports, computer services in particular, and the pharmaceuticals, were able to grow strongly through the pandemic period. Many other economies who are export oriented may have had different composition of their export sector, so they weren't able to weather that to the extent that we were. They would physical goods or other elements like that, car manufacturing, stuff like that naturally trends downwards when you have a cut in demand. Here we were able to grow quite strongly through the pandemic periods. You can see export growth was 14% 2021, nearly 14% again last year. So really strong export growth. But we are expecting that to slow somewhat this year as the international economy deteriorates. So even though we do have these sectors, we do expect that growth to slow somewhat. What's, you know, I've kind of alluded to it there, but, you know, what's really important for exports in Ireland? Well, it's ICT and pharma, really, that drives everything. You know, over half our goods are pharmaceutical, over half our services exports are computer services. So huge, hugely well-performing sectors with some of the best companies in the world performing in them. You know, so we're really lucky to have them here in Ireland. But you know, that does lead to some serious issues around concentration risks. If these sectors, or the firms in these sectors, were to experience negative shocks, that would have huge ripple effects for the Irish economy. So I think that's the major risks that we call out when we think about these sectoral concentrations. In terms of the labour market, as I've mentioned this before, you know, we had a big rise in 2021 during the lockdown phase, you know, up to 16%, but we've had a remarkable turnaround in employment. You know, last year, just under 5%. This year, we expect the unemployment rate to come down a little bit again. You know, we are operating at full employment in the Irish economy at present. You know, there is no spare capacity in terms of, you know, in terms of the sectors. The complexity that we have with this position is that even though it's great to have a full labour market, extremely low unemployment rate, but the difficulty then is that, you know, any increase in demand or any growth pressures in the economy are likely to increase wage demands, in particular around the cost of living crisis. And because there's little spare capacity in the economy, then it's likely that those wage costs are going to increase, and therefore it'll kind of, what we hope to not happen is that these price spirals where you've got wages chasing costs and costs chasing wages, and these kind of reinforcing price spirals can occur. And certainly with such a low unemployment rate, with such a low level of or such a high level of inflation, there is a considerable risk that these can start feeding back into each other. So to date, most of the inflationary pressures have come through the energy markets or the supply chain bottlenecks, but then there's a risk that these labour market or demand side inflationary factors can begin to become important, and that can be much more difficult to deal with from the Irish economy perspective. Okay, as I mentioned, I think it's important to talk a little bit about the public finances. You know, the public finances are in really good shape. They've recovered extremely well from the pandemic period. You know, income tax, which is a really good lens for what's happening to, you know, the broad employment base. You know, it's up nearly 20% on a year-on-year basis in the January to November period. You know, really strong tax growth. Corporation tax again is increasing astronomically, and that's a hugely beneficial thing, but also has huge risks around it that we need to think and plan. And you know, we're certainly hugely supportive of the commitments to move some of the windfall corporation tax receipts into a contingency fund, to a kind of rainy day fund, to be able to have liquid resources available if there's a materialization of those concentration risks. That said, you know, there are huge challenges ahead in many areas of infrastructure that need commitment: climate adaptation, housing, environment, changing transport linkages. All of these things are going to require investments, and we're in a lucky position that the state has financing available to do this. See the chart here at the bottom. You know, in 2021, we were running a deficit for the year of about 7 billion, and a remarkable turnaround. You know, we're running quite a large surplus. It's probably going to be a little bit larger than that figure for the full year 2022. You know, it's an extremely large surplus this year, so quite a remarkable turnaround. Yeah, let me just talk a little bit before I move on to the housing market. we are experiencing inflation rates that are higher than we've had in 40 years. We are the level of inflation for the full year last year, just under 8%, is extremely, extremely high. And it's come through the energy sector, it's come through, but it's starting to seep through into the food sector, and really you can see price pressures growing in many areas. You can see the chart here has the CPI, the Consumer Price Index, for all items, and then the one that excludes energy and unprocessed food, and you can see that is beginning to creep up through last year as well. So we do have these price pressures in the broader economy as well. We're expecting inflation to remain high this year, so just over 7%, but then we do hope that many of the indicators are lining up at present towards more normalized inflation into 2024. If the energy markets normalize, and there aren't a development of these domestic price pressures, then we would expect a moderation in the inflation rate into 2024. I think the two key issues that are facing, particularly thinking about who's affected most by inflation, I think that's one of the most important effects here, because inflation has hugely different distributional consequences depending on how much income people have. In particular, lower income households spend a disproportionate amount of their budget on food and utilities, the basics, and these are the areas where we've seen extreme inflation, and higher income households are able to absorb these shocks, but lower income households can't. So you can see the extreme pressures in all of these elements are, and this is why the challenge of dealing with the distributional effect, and as we've said on numerous occasions, having tailored and targeted measures to deal with those households who are most affected by the inflationary pressures are really the way to try and deal with this from a policy perspective. This chart is kind of nice. You can see the blue chart there on the bottom is kind of what I was talking about there. So it's basically the monthly annualized rate of change across different income groups. So you can see that the 10th decile is the higher income households. The first decile are the lowest income households, and you can see nearly 2 percentage points difference in the inflation rate. So very different across the income distribution. I think that's a key point. Okay, so let me talk a little bit about the housing market. So there's a number of different elements that I want to talk about, and I'm going to come at this really from the side of how are we thinking about the number of units that are going to be built. What about the supply side? That's really the element that we focus most on when we think about the construction and housing outlook, and that has a knock-on element down the chain when you think about the provision of different services that are required. But as Wayne mentioned in the early part of the introduction, when we're thinking about housing needs, or we're thinking about homelessness, one of the big issues that have been facing the state in the past few years is just not enough units available to be able to. So it's not just a resources issue, it's actually a physical number of units issue. So in that sense, supply is the key. Having more units available is the key. So let's think a little bit about that, and let's think a little bit about what factors are affecting that outlook. Well, one of the things that we saw very clearly for last year, I've mentioned this earlier, was a big strong pickup in housing completion. So it was, we had a drop in completions between 2019 and 2020 and 2021 with the pandemic, and that was completely understandable because the construction sector in particular was it was subject to restrictions for periods of time. And we saw some of that kick back in. You can see the chart here on the left-hand side looks at the annual housing completions from CSO, and you can see a big increase in the completions for this year. So we're going to get about 28,000, over 28,000 units for this year. So that's a big pickup. However, the challenge really is the outlook. So one of the leading indicators that we use to get a gauge on completions is commencements, so housing starts. And you can see the chart on the right-hand side here looks at housing starts. Obviously, we had a big increase on an annualized basis. The blue bars are the annual basis in 2021. So we had a drop in 2020 with the pandemic. Makes complete sense. And then there was some of that spilled back over into 2021, and that was a drop. But then we can see there's a drop then into 2022, and that's the kind of key issue that we're concerned about, because you know, starts now are a unit in 9 months to a year and a half. So if they're not coming through as starts now, it's unlikely they're going to be a completion in that period. So I think there's a number of factors that are driving this, and we kind of just want to unpick that. You know, I think if you look at the left-hand chart here, this looks at commencements a little bit more of a growth rate perspective. So it looks at the trend over time, and you can see here period over the last number of months that we had data when we compiled this, there was a kind of a downward trend in the number of completions, and that really is the problem. You know, that kind of trend downwards in terms of the completions. And you know, I always like to look at this planning permissions chart because it goes way back to 1975, and you can see that even though we have in past number of years had a pickup in planning permissions, it's still way lower than it has been historically going back. And you know, I think that when you think about the growth in population we've had and all the fundamentals shifting over the period, I think it's important to think about the activity levels are still a lot lower than what they were. As I said before, our completions forecast for this year are about 28,000 units for this year, about 26,000 units for next year. Okay, so what's holding back construction? I really like this chart. This comes from the European Commission. They do a business sentiment survey, and in that sentiment survey, they ask firms in different sectors what factors are affecting them. And I think for Ireland, for the construction sector, this is hugely fascinating. So what you can see quite clearly is that the yellow line here, you can see in the past number of months, a shortage of labor, which is the yellow line, has really started to kick up. So it's you know, into 21, into 22, that has kind of increased notably. And you can also see the very bottom blue line, which is the light blue line, which is the shortage of materials, that had rocketed during the period of the intense supply chain disruptions, but that has started to come down a little bit. So we have this shift towards labor issues and away from materials issues that is starting to occur. One thing which is kind of beginning to tip up is the orange line. Now, if we get the demand side, we still have rising house prices, we have high rents, we have rising interest rates. All of these factors are likely to work and the cost of living pressures likely to subdue the demand side a little bit. And you can kind of see that starting to tip up a bit. So what's the overall chart telling us? Labor shortages matter, supply chain issues are beginning to abate, demand is waning slightly, and you can see the dark blue line, financial constraints are going a little bit up a little bit. So pressure starting on the supply side. I think the inflationary issues are really important. You know, this chart shows some of the key inflationary input, key material inputs into the construction sector, and you can see this, you know, even though some of the pressures have been abating, the inflation has been staggering, in some of the elements. Structural steel, up nearly 40% year on year toward in the middle of last year. So, really strong increases in construction, all putting huge pressure on the market's ability to deliver units at the prices that we'd hoped they would. Okay, I think when we think about the outlook for housing, we always want to talk about house prices and rents. I think that the key issues. I think one point I like to make when I'm talking about this is, we still are seeing increases in rents. We're still seeing increases in house prices, but actually with the increase in inflation we've seen in the past year, the real value of these, which is if you take the inflation rate away from the change in the price growth for house prices and rents, it's actually, for house prices, you're getting quite low real house price growth at present. It's likely to maybe turn into negative in the period ahead, and rents are not really growing in real terms as strongly as they were. So the cost of living pressures are creating huge challenges, but in real terms they're pulling back some of these growth rates as well. Okay, I want to leave some time for questions, so I'm going to skip over a few bits that I had planned to do there, and I want to talk a little bit about Dublin, because Dublin is where a huge amount of pressures happen. Just before I conclude, I think a couple of the things that are worth noting for Dublin in particular, in the housing market, the highest rents in the country, the highest house prices in the country. House prices are extremely high, and the median house price above 450, which is extremely high relative to income, but also has some of the strongest demand fundamentals, and also more challenging land activation issues. One of the points we wanted to note about Dublin in particular is that with the relaxation around the central bank regulations, the LTI measure, that's likely to affect the Dublin market the most. It's likely to affect the components of the market which were most affected by income constraints. So where you needed more leverage relative to your income, so you needed to get larger loans relative to your income to buy houses, that loosening that constraint is likely to affect that component of the market more. So therefore, expect this type of credit liberalization to be more supportive of the components of the market, like Dublin, where that was affected. So that is likely to, even if some of these other pressures I talked about are going to be abating demand, that's likely to be able to offset that within that particular pocket of the market in particular. Okay, so I'm just going to skip over a few things there and just conclude, because I want to leave some time for questions. So how do I sum up the broad economy? We still, last year we had really rapid growth coming through exports in particular and investment, but household spending has been on a downward trajectory, and that's our best lens into what's happening on the ground in Ireland. In terms of the outlook, we're still expecting growth this year, but we are expecting that to slow as the cost of living pressures kick in, as the interest rates start to rise, and as some of that business uncertainty and those cost pressures on businesses spill over into the labour market. The public finances are in really good shape, but we do have those extreme concentration risks, in particular with the corporation tax rates. So the planning moves around developing these rainy day funds, or these alternative, this storing of some of that wealth for use in the future, or its deployment towards non-current critical capital infrastructure, really is our key, given that could, the windfall element could evaporate relatively quickly. As I said, the key risks, is that we would see will be an acceleration of the global downturn, energy price shortages, or a greater than expected snapback in interest rates. In terms of the housing outlook, and I said I'm talking an awful lot about construction in terms of output and supply, because that's really something we focus a huge amount on. We are seeing some price moderation in real terms. we saw supply up last year, but there's a risk to the outlook going forward. And we really need those units because we have huge housing need across the board. Looks like some of the inflationary pressures are beginning to abate, which is a good thing, but interest rates are rising, which is going to put pressure on the demand side. And there is a huge amount of uncertainty still out there. And look, with that, I will hand it back to Wayne and say thanks very much for your attention, and I hope you've found that useful.
Thanks a million, Conor. So the first question that came in there was actually to ask if we're okay to share your slides. So just for
yeah.
Yeah. No problem. So for anyone who doesn't, we'll follow up with an email so that the live link, the recording will also circulate to anyone who signed up. So we'll include the slides in that as well. So thanks to Conor for that. The questions are starting to come in. There's a question here from Felix. Could the current accommodation situation be described as a rainy day crisis? If yes, would allocating today an element of the existing 6 billion rainy day fund to a one-off housing apartment building programme by the state local authorities be helpful?
I think that's actually a really good question. And my colleague Kieran McQuinn has done a number of papers which kind of suggests this in a way. I think, when we're thinking about what do we do with these windfall tax receipts, well, the one thing we definitely don't want to do is build them into current spending, right? We want to make sure that if they evaporate, that doesn't affect the delivery of services on a day-to-day basis. So then we've two other options. We save or we invest. And I think it's probably appropriate to do both. So investing in long-term infrastructural deficits around housing, or the other big one, climate adaptation, I think, could be very well warranted if they add to the productive capacity and add to the ability to deal with the infrastructural bottlenecks in the economy. I think that's entirely appropriate. One of the challenges really could be if we just do too much in the construction sector and it doesn't have the capacity to be able to deliver that level of investment, because the outcome of that would just be inflation in that sector across the board. So I think we've a balancing act there, but I think that's it's worth considering. How can you use some of these funds? You're going to save some, you're going to invest others. How can you best get the best bang for your buck with those resources? And I think being able to deploy them at critical infrastructure bottlenecks like the housing market, which we think we're all pretty agreed that is a critical infrastructural bottleneck. I think that could be an entirely appropriate element in a plan to use these windfall funds.
I might actually just say to everybody, do use either the chat function or the Q&A to put in any additional questions. I was going to, but I see questions are flying in, so I'll keep going with the questions people are asking. We have Paul Sheehan, my colleague from Cork, who asks, how do you think consumer confidence will be affected by falling inflation but rising interest rates?
Yeah, that's a good question. So the rising interest rates, are going to be a particular challenge, for different components of the market, right? So if you are a highly leveraged borrower, then you're on a variable rate or type of arrangement, your servicing costs are going to get much more difficult to pay. So you're going to likely to have a more increase in servicing costs. That's likely to have an uptick in the burden from those payments. Maybe increasing your arrears a little bit, but also it's going to decrease credit demand. It's going to decrease credit demand in the housing market. It's going to decrease credit demand for consumer loans, your car loans, et cetera, and all of that is likely to take pressure out of the economy. So I think that is really the channel through which the monetary policy authorities are actually hoping it's going to work, right? They're raising these rates to try and choke off demand in an aim to try and bring inflation back. So that's the aim. I think they would be perfectly happy if some of these things happened and inflation came back down again. So, but I think it really will depend. If you're a leveraged borrower, it's going to be much more difficult. If you're a non-leveraged borrower, you might just postpone that investment or consumption decision, and that's really the way that the interest rate channels will work here.
Okay. I think Dahi's asking, I think you might have answered some of it, but another question here from Dahi Danny. Does CBI credit liberalization risk greater pro-cyclical asset price inflation when what we need is a sustained moderation in price and rent inflation related to income distribution?
Yeah, I think there's actually a huge amount in that particular question. Let me deal maybe with the macroprudential regulations in first. So all else equal, if you loosen credit conditions, you're likely to have an increase in house prices. That's what we've seen from all of the international literature. With the central bank rules in Ireland, particularly the loan to income anchor, that was very strict in an international context. You know, the Irish 3.5 was certainly much tighter than the Bank of England's 4.5. So the thinking around that was that some of the costs associated with tight credit to income ratios, were needed to be readdressed. So therefore, having more leverage was likely to be required in the medium term, because with the macroprudential regulations, you want a framework which over time sustainably controls credit growth in the Irish economy, and I think that's what they were thinking. I think one of the question. So I can understand that change, and the pros and cons of that change are very clear. The timing is what's interesting, and I think that's the timing was certainly unexpected from our side, but I think the thinking there is likely to be that with the rise in interest rates, any increase in demand that comes through looser credit conditions is likely to be choked off by the higher interest rates anyway. So there's going to be an offsetting effect at present. So you're liberalizing one condition when the other is tightening, and you're hoping the net effect will offset one and the other. So I think that's but I think still, if you look historically and cross-country, cross-sectionally in a cross-country context, Ireland would still have a reason at 4 times income would still have a reasonably prudent macroprudential regulatory structure.
Okay, thanks for that. And I think there's also, I was actually at the presentation when Baz, who actually has done a presentation for Simon previously, was talking about it. And one of the things that struck me, certainly in the way they talked about it, was actually it was more about the banking system than it was about housing and people's ability to purchase. It was really kind of, that's the job of the banks, and to manage that. Our job is just to focus on the banks. So it was really about giving more leverage and scope to banks to manage their monies and their thing, for me, which I think was an interesting narrow purview to have, which is slightly concerning.
Well, the aim, I think, just to come back in on it, I think the aim of those rules are twofold. One is to build bank borrower resilience, so both banks and borrowers can adapt to shocks. And the second is to break house price credit spirals. Okay, so they're the two objectives of those regulations. And I think in Ireland, for the new borrowers that have taken out leverage over the period since the macroprudential regulations, I think it's very clear that is a much safer pool of borrowers than we've had in the past, because of who got loans and where across the income distribution, etc. So I think that makes sense. But then and then the credit house price spirals are likely to be one, it's likely to be prudent on an international basis, but also the rising interest rates are going to do some of the lifting in terms of the house prices at present. So I think that is why that happened then.
So Lorcan Sir, again, another regular contributor to our Simon Talks, and this is the point he's actually made very well in one of our talks, which is when we're looking at housing supply, very little analysis breaks it down to overall supply, and then how much of that supply comes to the market as new housing available to purchase. In 2021, this number was about 30% of all housing output. Does the ESRI have a view on whether this is important and or how to increase that percentage?
I personally don't, because I haven't maybe thought about it like that enough, and I like to think these things through before I make any comment on them. And I wasn't aware of that figure you had there, Lorcan, which is pretty interesting. Look, I think it is important that output comes through to purchase for sure, but the non open market purchase stuff like that's a very heterogeneous basket of things. You're talking there, about many things. I know there's the build to rent sector, which is involved in that. There's also the AHBs, there's the local authorities. All of these social housing providers would be purchasing properties to try and deal with social housing needs. So I think it's not as simple as saying for sale is good, not for sale. Like there's huge complexities in the delivery of the market. To be honest, I just think we need more of everything. We need more of the supply that comes in for social housing by AHBs, by local authorities. We need more stuff available for purchase, and there is also a role for build to rent type arrangements, in particular in the core city centre areas, where you have mobile workforces who on high incomes. So I think we, rather than a proportion of a fixed stock, I think we just need more of everything across the board.
I would join those. In my thinking, there's a need to join up those two things in thinking. And so the first question, which is one that I had written down, if nobody had asked it, about the rainy day fund and the housing crisis, because obviously I would. And I think Lorcan's question also raises or gets us part of the way to asking one of the other important questions, is that it's not just about supply of housing, although that's absolutely critical, and I don't underestimate, but it's also about affordability. Yeah. And we know that increased supply might have an impact on affordability, but doesn't create affordability. It's about how you do it. And one of the things about inserting more money into the system, particularly in the context of limited labor and those kind of things, is that one, it can increase costs or have an inflationary aspect to it. But the other thing is, does it stall innovation? So when we look around the rest of the Europe and the use of different building techniques to bring in more cost-effective, more carbon neutral, and faster building of housing, if we continue to put money into the system, but it's not targeted to drive innovation and drive supply and affordability and purchase that, are we at risk of doing I don't think you can do more harm by ordering more housing, but not creating the balance. It has to be really well thought through. And are we doing enough of that thinking, I think, is one of the questions.
Yeah. Well, I think it's very clear that if we could find more innovative ways of developing housing at a lower cost, that would be hugely beneficial to the system. For example, is there a better way of using modular housing or factory built type units and stuff like that? I think one of the challenges for Ireland is that often you need these things at scale, and you need them at scale in markets that are bigger than Ireland, right? We're a small peripheral market, a European context. So it's very difficult, to have scale in anything. So I think we should be completely open to all of these changes if we possibly can, and we should scope them out as much as we possibly as is possible. But it's likely in the short term that we're going to have to continue with the current structures to be able to do reuse. But I think there shouldn't be any barriers to innovation, and there shouldn't be any barriers to, we should try and do our best to remove barriers if they are the case. I haven't done much research on alternative building techniques. That's not really my area, so I couldn't really comment on how good or bad are we in a context. But certainly if there are better, cheaper ways of doing things, we should be willing to explore them, of course.
But I suppose the question wasn't about, or what I was trying to think through is if we, because the call is constantly on government to increase the budget, increase the budget, increase the budget, increase the budget.
Yeah.
But are there circumstances when actually just increasing the budget isn't the right, it's actually about spending the money differently? I suppose it's part of the, you don't have to, it's not necessarily, I don't want to keep throwing questions at you, but that was what I was trying to get to.
Well, I think, it makes sense. That it's not always about how much you spend, right? It's how you spend it, right? Of course, I don't think there's any ambiguity on that. But it's very difficult to be able to change industry structures in a short period of time, and to change building mechanisms, change ways. Maybe what it needs is and this is maybe where things like the infrastructure fund, the rainy day capital, or the spare capital could come in, is that the state could act as a guarantor, or commit to units if a new mechanism or modality was available, but needed scale. That maybe the state could be the scale. So look, there are options there, and I think they're worth exploring. Structural change can be difficult at times, but it can be hugely beneficial over time.
I think that's pretty much a good place to stop. I want to thank Conor in particular for his, as usual, really useful insights, but also, and I think you showed it again with this presentation, is the importance of joined up thinking across all those different aspects, and the way you talk us through it is very engaging and easily digestible, but for what are very complex, multi-denominational, I can't even describe it. That's how complicated it is.
Dimensional.
But I think, like, as the example, the talking about the announcements recently about the ICT sector, and those you can start to feel, oh, everything's fallen off a cliff, but actually then you overlay that with employment numbers, and it puts it in the context that I think is really important for us to think these things through in that kind of multi-dimensional ways. And I think that's really useful, particularly when we're grappling with an issue as complex as housing. So that's really, really useful. I'd also like to thank those people online who've been watching in for what has been a really good engagement, and I think it's a testament to Conor that we got the number of questions and really insightful questions that we got. So it isn't always the case when you do these things, so it's really good to see. And so thanks to everyone again, and we will be doing the same again next month, so do keep an eye out. There'll be an announcement coming in the next week or two around who'll be speaking up next. So with that, thanks to everyone, and enjoy the rest of your Monday.